Schwab and CB3. You should have gotten a letter from us. I have it on my desk here. I'm going to refer to it a little bit during this segment. Normally we would do this in a private show to our clients, but so many of our clients are watching this show and we wanted you to be aware of what's going on. If you're not a client, maybe you'll be interested in what we're doing it and why we're doing it. So listen up, I hope. Here's why we're moving your assets to Schwab. So we did a due diligence, 5 months of intensive research. We compared 4 major custodians. Client feedback was that the #1 request was for login consolidation, meaning people didn't like having multiple passwords, and I don't blame you. We have solved that problem with Schwab. That was one of the deciding factors that made Schwab the clear winner. Number 2, the numbers matter. Schwab is a much bigger firm, 11.7 trillion in custody. That's with a T. Interactive Brokers at 484, about $500 billion. 50 years of Schwab stability and innovation. When you are this big, it allows you to have services and 24-hour support with English-speaking people on the line 24/7. I called them. When we were beta testing, I called them on Memorial Day. I called them on other holidays, Sunday night at 4 a.m. And somebody smart always picked up the phone. And I think you'll find that too once you get there. And some of you are already there and some of you aren't. We're going to talk about the onboarding in just a little bit. Okay, commission-free stock and ETF trading. So that means your stocks and ETFs are free, commission-free reinvestment of dividends. Options trading is only 65 cents per contract. You might be saying, well, I don't trade options. Actually, you're going to be. We'll get to that section in just a minute. We've had 2 clients say to me, well, I can get free trades anywhere. It's not a problem. Yeah, you can as an individual. But for me as a registered investment advisor, we were still paying commissions at Interactive Brokers because that was the deal. It's just the way it was, and there was nothing we could do to change that. That goes away now, saving thousands of dollars, and I'll put the amount. It is in the letter that I sent you. So it's going to be in your favor for sure. The 4th reason, superior execution. So Schwab's price improvement on fills. When we submit an order, usually we use limit orders, sometimes market orders, but we'll usually use limit orders. And Schwab has so many orders going in during the day, again, because they're a huge, huge firm. We can see a price improvement of $0.01 to $0.015 per share on average, and that is significant. So it achieves on average execution speed of about 0.05 of a second, which is, Interactive Brokers we didn't have a problem with their execution speed, but their markets weren't always as deep as what we're seeing and what I'm seeing in Schwab. You guys don't pay attention to this, obviously, but it just helps it, the quicker and better fills saves you, it allows you to have, I keep going back and forth because I want to be on camera, but I want you to see the data too. I want you to get lower buys and higher sells. That's what we're trying to do. And we're going into the most liquid markets and the stocks we're trading. And we want to be able to get the very best fills we can for you because every little penny here and there adds up over a decade or 2 of investing. So their advanced order routing technology prioritizes execution, price, speed, accuracy, liquidity, service levels, etc. And so far, I've been really, really pleased, and I've been trading for 30 plus years. So that is really helpful. So the 2nd reason, householding. This was the #1 reason clients wanted to be able to see what the spouse sees. And if you're single, just hang with me on this. It's still going to be useful for you, but especially useful for our couples because, John has one login with a password. Mary's IRA has a second login with a password. He's got a taxable account, Roth. Mary has a Roth, a trust account, a college savings account. And all of a sudden, this just adds up like crazy. And sometimes you can consolidate these, but you have to call the broker dealer and get that done. So it's easier with the householding feature at Schwab. So you create your first account. If you already have a Schwab account, you're not even going to have to do that. Because when I send you an account invitation to move, say, your IRA from Interactive Brokers, it's going to send you an email. You're going to click on that email and it's going to ask you to log into your already existing account because Schwab knows who you are. They know your social, your phone number, your email address, and you're going to add your managed account to your existing login. If you're not a Schwab client, for the first one, you'll have to create the user ID and password for each spouse one time. And then as each account gets added, it's really straightforward. Two-factor authentication for security, really outstanding, okay? And the mirroring of accounts. So once this is all done, we have found that spouses want to be able to see all the accounts. So Mary wants to see John's IRA, John wants to see Mary's Roth. They both want to see the trust account on which they're both trustees. All of this is possible and happening right now with Alice and my accounts and the other clients that were the first ones that were willing to beta test and be guinea pigs for us. Okay, we didn't want to put all of you through that, but I have some clients that are really into this tech stuff and volunteered to do that, and it is working as promised. So you can trade any account for each other if you want to trade your own account. All right, you see the exact same account lineup and no more, honey, what's that password again? And you know that happens, all right? And the audit trail shows which spouse did which. So you can follow, well, so-and-so logged in using this password and so-and-so logged in using this password. And there's an audit trail, how often you're looking. You don't have to see it if you don't want to, but it's there. It's kept as a record. So I like that a lot. And consolidated reporting. So one monthly statement for all accounts, unified year-end reporting to the IRS, consolidated 1099s, and performance reporting across the entire household. So you can see just all of your accounts, or yours and your spouses or your kids. We have families that have children, that have grandchildren, that they want to be able to see the accounts. And the grandchildren say, well, you're funding my account. So yeah, you can see my account. All right, it's just helpful. In fact, anybody that wants to let you see their account, you can get permission and Schwab will add them to your login, but don't let that get too crazy. So you see the point I'm making. All right. So mobile integration excellence. I really like their mobile app. And honestly, I liked Interactive Brokers too a lot. But again, it's the aggregation, the householding. There's the word householding of all the Schwab accounts on one phone with a drop-down arrow. You can see everything there, the fills, all kinds of market news, etc. Face ID, Touch ID, Apple Watch app. And I like this because, as you guys know, I wear an Apple Watch for quick checks of what's going on and push notifications for all accounts. So if I make a trade and you really want to know about it, your phone can blow up and see, oh, so-and-so just bought Apple and, sold Microsoft or whatever. So all this is here. You don't have to use all of it, but it's there. I'm going to get a breath of air because this is going to be the most detailed section. If you have questions, put them in the chat box. You're about 25 seconds behind me. And I'll wait for a moment to see that if that's there, and I'm going to get a sip of water here. And I'm kind of hoarse tonight, guys. I'm sorry. Hey, Money Mike, welcome to the show. I think you're a new viewer. Dollar cost averaging is a good idea on those funds, right? So there's all kinds of funds available now for cryptocurrencies, and the more the merrier. I like seeing those out there so you don't actually have to have a separate crypto account. Thanks for sharing that with us. All right. Let me get back to where I am here. I always get mixed up when I get a drink, but I need to do it. My voice is parched. So, options hedging. What do the professionals do? The professionals don't put stops in the market because of crazy days like in April when Donald Trump announces tariffs, or crazy days like the Fed announcement yesterday. All right, they use hedging. And that's what we're going to be able to do now at Schwab, which I was not able to do at Interactive Brokers right after that April 9th through 12th period happened. And we got stopped out of a lot of assets in CG and GI. And then we were in a lot of cash on April 12th when the market rocketed 11.3%. And we've been playing catch up since. And we've caught up some, but not entirely. But that would not have happened had we had options hedging in place. So let's walk through this. When you hear about options, I know you probably think it means risky, speculative, etc. And it is true, it does, but not for you. The way that options are used in our managed accounts is for hedging. That means to protect to the downside because we have stocks protecting, so to speak, to the upside. All right. So imagine a Maserati, 150 miles an hour, without airbags, without seat belts, without even a bumper. That's what it's like investing without hedging in today's markets at today's valuations, with the S&P at 6640, geopolitical tensions everywhere, AI bubble concern. Going unbalanced isn't brave, it's just simply unsafe at most of our ages. Now, what do I mean by that? Some of you on this webinar tonight, or podcast, whatever we're going to call it, have been with me since 2004. I think that's the earliest one. So we're at 21 years. All right, that's a long time. We were in our 40s then. We're in our 60s or even early 70s now. It's a whole lot different thing. And I'm going to show you the 2001, 2008, 2009 downturn and what it would have meant back then if we had had this technology available. Okay, so realize that we can't afford at our age to have that kind of downturn. If you're 35 and you don't want to trade with options and have a protected portfolio, you don't have to. There is no requirement that you do this, but 100% of the people that have come on board at Schwab are doing it. I'll just tell you that right now. So options, when you sell them to someone else, you are taking a risk. You are speculating on the market moving one way or the other. It's high risk, high reward, unpredictable outcomes. It is not appropriate for client accounts. It is not for your portfolio. Hedging is when you buy options, specifically put options. A put option gives you the right, but not the obligation, to put the asset, a portfolio, if you will, or the downside risk of a portfolio, to someone else. That sounds kind of oblique, but basically it means the options are making money when your portfolio is losing money. And that is the sole reason to have these options in the portfolio. They're only going to be 4 times a year that we place them in, and they stay in all the time, and then they rotate, because an option has a limited life. It's not like you buy an option and it's just always there. They expire every month. Some expire every day, some expire once a year. We're using the quarterly options. All right, March, June, September, and October. We'll talk about this going forward. Okay, so the put strategy, and guys, this is a little techy. Feel free to go back and look at this a second time, but I want you to understand it. I want it on recording so you can understand it. We're going to buy put options 2 standard deviations below the market. That's the long put, because it will encompass 68% of market moves in the first standard deviation. So I'm going to go back on camera for this one. We don't need to protect against slight downturns. All right. 68% of all market moves that happen every day, every week, every month, every year happen in the first standard deviation. All right. We don't need to protect against those, because that's just normal up and down moves that most people just don't care about. Down 2%, down 4%, maybe 8. Okay. Now we're down 12, 14. Now we're starting to pay attention. All right. When we get to that 68% range, that's the second standard deviation, and that's where we're buying the puts, roughly speaking. And I'll get to that more with some graphs here coming up. We're then financing this partially by selling puts. So that seems like it would go against what we're doing. Well, we're doing that in the third standard deviation, because those short options, we get money, we get income from those. And those go to reduce the cost of the long options. I want to give you this insurance at the lowest possible cost. I mean, think Progressive instead of, the most expensive Kemper or whatever, is out there, Lloyd's of London. All right, doesn't mean it's inferior. It just means that I could reduce the cost, and I'll get into more detail on this, but that's the purpose of this hedging. The net result is a protected zone between these 2 strikes, and you can see the graphic here. Now, the 660 is a number for the S&P, and then the 550 is where the short put is. So there is a protected zone, and then after 550, it doesn't protect any longer. And you might say, well, that doesn't make sense. Why would I only want to protect some? Well, because it's expensive. And if the market is only going to be in a third standard deviation 5% of the time, do we really need to protect against that? The answer is yes, and that's what we're going to cover right now. But the second standard deviation move, which is where the long puts kick in, has already worked for us in August and September for those that are already at Schwab. And that would be Alice and myself and just a few select clients. And they've seen it work, especially 3 really ugly days in August. Okay. So Here's the mathematics. 68%, I used this number earlier, stays above this level. So you're not going to need these options when the market is in a normal range. Normal meaning it's not in a double-digit drawdown, okay, or correction. We're protecting against the worst 32% scenarios, and we're financing this by selling that put in the third standard deviation because we don't believe more than twice a decade we're going to hit that third standard deviation move. If we do, we have a plan. You will see that coming up, all right? But those long puts are going to kick in many times during the year, and the market touching those short puts is highly unusual. It doesn't mean your account blows up, by the way, if those short puts hit. It just means you don't get any additional protection unless I take action, which I will explain now, okay? It's just not that complicated. So what if the market keeps dropping? That's a fair question. Well, we can add more long puts. Let's say that for your account size, you have 10 long puts, right? Hit that second standard deviation. And by the way, everybody will have that same exact position because I can trade on a block. All right. If we get down into an area and the fundamental data tells me that we have more to go, and the technical data tells me that, fundamental and technical, I can buy more long puts, or I can do something that's called move or roll the short put lower. I can even just remove the short put if I think we need more insurance. This is for extreme moves like 2008, 2009, not even like COVID, which was 32% and done like in 5 weeks. Those long puts would have kicked in for sure, but they wouldn't have been around long enough. No pun intended. They wouldn't have been around for a long enough period of time to get in the way of those short put sales. All right. So we would have had the benefit of it and the lower cost. All right. Feel free to type in the chat box, guys. I know this is techie and I have plenty of time. The show's a little shorter tonight on the rest of the material because I wanted to cover this so thoroughly. So here's what it looks like. A $100,000 account without protection drops to maybe 80,000. All right. With the puts on the right-hand side, selling at the second standard deviation, financed at the third standard deviation, maybe we're seeing a loss of 86 or down to 86,000. So that is price improvement, right? And the way this maps out here is unhedged 20% loss, hedged maybe a 14% loss. Now, I need to say, don't hold me to this in the first downturn. Why? Because the option moves are visceral. I may or may not have placed the strikes exactly at the second standard deviation because the strike may not be available. It might be in between strikes. So it's going to be close. All right. And at the same time, as the quarter moves on, the options lose what's called delta and vega. Sorry, this is Greek stuff. I'm going to come back in October and get in a little bit more detail on this. But just know that that is their function, is to reduce extreme losses. I think to go from a 20% loss to a 14% is substantial, and most people would be satisfied with that. All right. So because of this block trading, I can execute 500 contracts plus with up to, I think, 65 clients, and we're not over that right now. All clients receive the same fill price, just like on stock. So that's what a block trade is. When we buy Microsoft and sell Apple, and we do that in CG, I do that on a block order, and every client gets the same order, and I'm the last to get filled. All right. Both ways. I'm never the first. That's called front running. So I'm the last. That's what they do for what they call house accounts. So the timestamp will prove that equal treatment, and that's what we want. In all fairness, we had that block treatment with Interactive Brokers, but we just didn't have it on options. So this is what happened. This was our roughest day of the year, April 12th. I don't have the dates on here, but Trump made his announcement. You can see the tariff announcement. You can see we're in a downtrend, right? The red bars, you guys know by now, red bars mean down, right? Green bars mean up. This is the S&P 500. It tries to correct, and then Trump comes along on April 1st, and boom. So we have to get out of the way of this because we don't know what's up ahead. It's real easy to say now that everyone knew, well, no one knew, that Trump was going to say, never mind. That was too strong. We'll defer that 90 days. And then the market rockets up 11.3%. All right, I got a good question here from Mark. So what about margin? I saw some trades involve margin trades. Should I be worried? No. All right, this is good. Good. Paying attention, Mark. Thank you, sir. Now, It does take margin to do this, but this doesn't mean that we're borrowing money from your account. Anytime you have a short option in your account, you use what is called limited margin. You can't borrow cash from another holding, but it allows you to hold a short position. The SEC and FINRA agreed on this. It's called level 2 options privileges. Those of you that are already trading at Schwab have level 2 privileges. I just added one today and traded him into the program that came over from Interactive Brokers. All right? It is nothing to be concerned about. We are trading now. We used to trade with 99% invested and 1% in cash. We are trading with 96% invested, 4% in cash, but it's not really cash because 2 to 2.5% of that is trading options. So that means on $100,000, you could spend about $2,000, all right, to trade that particular account and have that hedge. Is that $2,000 worth it? If the market is straight up, you're going to wish that you hadn't spent that $2,000. All right. It's just like owning a house. When you go to the closing and you've owned it for 20 years, you go, gosh, we never even filed a claim. I wish I could just go back to the insurance company and say, never mind, right? And get all my 20 years of premiums back. But if the market has a COVID or worse, it has a 2008, that insurance that you're paying is well worth the risk of not seeing the portfolio go down. So let's go back to 2000, 2001. I want you to look at this carefully. Mark, I hope that answers your question. If it didn't, type in the box and let me know. So you can see the years here. I wanted you to see this. You see the sell signal. These are monthly trading signals, okay? You can see the sell signal way back in July of 2000. This is the beginning of the tech wreck, and it never looks back. Now, remember the previous slide, how this huge gap higher happened because of what Trump said. All right, but we had to protect you because it could have gone down just like it did right here. Okay, right here. Now, you might say, well, that's not more than about 20 bars. That's not too bad. I mean, I could have held on for that. Well, no, because those are monthly bars. Look at the year at the bottom. So you went on a sell in July of 2000, and the market bottomed in August of 2002. And then the next buy signal wasn't generated until May of 2003. That is a long time to be feeling that pain. Now, in a downturn that big, we would still be taking stops. So that's the next question I get from people. So now are you using this options hedging and not using stops at all? That is not true. We are using stops. We are not using what's called intra-bar stops. So we can not have to place our stops in the market. The options give us time to let the market cool off. If any of the stocks that we have hit a stop, we don't have to exit right then. We can, again, wait for the market to cool off and exit at a better price. You can see on this chart, even in these downturns, the market does move up, and that would be an optimal time to take the exit and not have to, again, do it, in a panic. So then the market moves unabated up from 2002 to 2008. All right, and then we have the financial crisis. You remember this, when all the liar loans came in and credit default swaps. We've had this discussion before. All right, straight down. It never looks back. Those are monthly bars, 6 months in a row. Actually, only 5, because one of them was a break-even month. All right, we would have been stopped out way long earlier, but not had to do so with a sense of urgency because the options would have protected the equity. Now, when I say protect, the market at the bottom in 2008 was down 56%. Warren Buffett was down that much in the NASDAQ. We were down 37%, which we thought was pretty good, and most of our clients did too. Not a single one left when they knew that we beat the market by 2,000 basis points. But with this technology, we would probably be down 30 to 32%, which is still a lot, but compared to 56, I think you guys get it, right? I mean, if the market goes down, we're going to go down, but the idea is to not have a career or life-changing loss. And then after that, the market has been pretty much straight up since then. All right, any questions? Put them in here. Very good. Systematic hedging schedule. We're going to do this March, June, September, and December. We're going to align with the quarterly rebalancing across the industry, quarterly rebalancing. We're going to roll these spreads 4 weeks before expiration. So options expire. Most of the decay of an option just expires, and they are decays, I should say, in the last month. By the way, if you haven't watched the interview with Paul Giganti, you really should, even if you just get into the options hedging section. It's really good. So I would recommend you do that. And then we're going to adjust the strikes based on new market levels. So this is a visceral living process, all right? We will continue to adjust this as needed all year long. Now, it doesn't mean we're doing it every day or every month. We're doing it every quarter. So we will take and assess. We're slowing down the speed at which we're making adjustments. It has allowed us to increase the position size of stocks from 3 to 4%. We still have some 3% stocks. We have a lot of 4s, some 6s, some 8s, not in GI, but in DS and in CG, because we have this protection. All right. So just really, really excited about this, guys. I don't know any other way to say it. So we'll never leave the portfolio unhedged. But again, if you just want everything, you're willing to take the complete unhedged risk, which you have been doing all this time at Interactive Brokers. And I know some of you haven't liked it, especially in DS, where you had a 44% drawdown in 2022. That would not have happened with this. Okay. So the psychology of protection, this is studies, and you can see the footnotes at the bottom, that hedge clients report 74% less anxiety because fewer panic calls happen during market drops, no emotional sell orders. And I don't mean that I go Barney Fife on you with my eyes bulging out and place sell orders, but I have had people this year call and said, I want to go to cash. I want to go to cash. I can't stand the pain. And in one case, it was really, really bad timing. And we'll see on the second case, there was a third case too, but then they decided at the last minute, no, I'm not going to do it. So the problem is you just don't know what the market's going to offer you. If you can perfectly time it and go to cash, like on this screen that I showed you earlier, I'm going to go back here. Oh yeah, when it says sell, if you can go to 100% cash, you're going to dramatically outperform my hedge. There's no doubt about it. The goal is to not do that, of course. The goal is to always be in there and soften the ride on the downside. So marriage is saved. I know. I do have a story, though. I really do. Over 30 years of doing this, I have a couple of them, all right? But missing one recovery could wipe out years of gains. Even if not years, it can wipe out a year's worth of gains. I mean, if you got out of CG in April, anytime around Trump's, and you know, it's 22% up from there now, and that's just the frustration. I get it. I totally get it. But it's just something if you don't have to do it, you know, if we can offset those losses by 15 to 32%, that's what we're trying to do. All right. So the monthly market review, this is the shortest segment I've ever done on this. As you can see, those of you that watch the show, you know this slide. It just comes along every month or so, every other month. In 100 years, we've had 3 secular bear markets, and this is not one of them. We've had 3 secular bull markets, and they last about 20 years. We're about halfway through this one. That doesn't mean it ends exactly in 3033 or 2033, sorry. But right now, it certainly is on track. And I tell you what, yesterday, when the market sold off, I don't know if anybody watched this intraday, it was just selling hard. And, you know, after Powell, it's not even so much when Powell makes his announcement, it's when he gets up there and it's all mealy mouth. And they're selling the futures just hand over fist. And then deep pockets come in, and these huge green bars come out of that because somebody's just buying S&P futures in 10,000 lot orders. Just crazy. All right, that's how you know you're still in a secular bull market. Because when things go down, nobody's folding their arms that has big money. They're buying just arms over fist, all right? Fist over arms, whatever the phrase is. And this helps. 498, let's call it all the Fortune 500. We've only got a couple weeks left in the quarter. Technology, healthcare, communication services, and financials. They're the winners, all right? 80%. Those of you that have been watching my show for 5.5 years know that 73% is the norm. That's a good number, but 80 is just crazy. And look, financials, 84%, healthcare, 87%, technology, 93%. Just insane as far as beating their earnings expectations, right? How does this happen with everything that's going on in the world, with Putin, with the Israeli conflict, with Hamas, with quote inflation, bearing down our necks here, with all the geopolitical strife, because the market doesn't care. It may care for a day or two, but in the long run, I don't care, is what the market says. All right. U.S. policy, guys, I only have one slide for you. We have to get to a place in America where we're not killing each other because of something that somebody says. Now, you know that I postponed last week's show to tonight because I was just really overwhelmed by what's happening in this country. And it deeply concerns me. I know this is a financial show, and so I'm going to get to the financial part here, but I wanted to say that so far. Here's the thing. You would think that the first political assassination, now there was an attempt on Reagan, there was an attempt on Ford, but it's been since Kennedy. Now, Kirk was not a president, although many people believed that he would be the Republican front runner in 2036, J.D. Vance in 2028 and 32, but 2036, he was 31 years old. All right, you would think that that would have brought volatility to the market. So, I mean, no disrespect to Charlie Kirk's legacy, but even that cannot stop this market. And when I see that, it tells me that almost anything can happen. And between the earnings and Fed rate cuts, this market has a long way to go. And that's my main takeaway for you tonight. I still believe this bull market has a long way to go. Guys, that's my show. Appreciate you being here. If you got questions, type them in. If you're new to the show, please subscribe to us, and you'll get a little notice in the email that we're going live. If we have a pre-recorded show, you'll get that notice too. I have a podcast that is out every single week. Sometimes I take a break, but mostly it's there. And then I tweet every single day on Facebook, X, and LinkedIn. Next show, only 3 weeks away because we started late this month. Thursday, October 9th, we'll know at least an idea of what the Fed's going to do by that time. Their meeting will not have happened by October 9th. All right. And as I just mentioned earlier, the podcast, we'd love you to join those and get, it's just audio, and it's easy to see us on, Amazon or Spotify, Apple, of course, just pretty much anywhere you get your podcast across the country. So 2 things I'll leave with you here. If you're going to type a question, type it now. We got that 25-second delay. So people who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. Calamitous drops do not scare them out of the game. I'm going to disagree a little bit with that. Maybe when you're 30 or even 40, maybe really early 50s, but 60s and 70s, calamitous drops, word of the day, calamitous, calamity. You don't want those. And that reason alone, I have 2 of my well-heeled investors who have been on a beta test with me, and they said, look, I know you're touting all of these other things, just the options trading alone, for me, Charles, makes it worth it. And so we're really glad about that going forward. So the other message I have for here is the secret to being successful from an investment perspective is having an indefatigable and underlying an unquenchable thirst for information and knowledge. I hope I have that. I love what I do. I just love what I do. Or you have to be constantly learning and constantly growing, constantly adapting. And if you are, you're going to be successful. And that's what we try to bring to you. That is part of our value add that maybe other wealth managers don't do. We're a portfolio manager. That's different. Markets are dynamic, they change. And if you don't change with them, you will be left behind. I believe, and we are, based on the options trading desk that I talked to, I told him what our book was. And he said, that's probably the smallest book we have that's doing hedging like you're doing. I said, well, I've been doing this 35 years. He said, well, good, because options volume, and I knew this, but they said, we're really proud to tell you that our options desk had our busiest year so far, and that's because options trading in America outpaced the New York Stock Exchange for the first time in May of this year. It's an astounding figure, and it's not because of speculation, it's because of hedging, okay? So in summary, I always say this as we close the show, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. Guys, thank you for joining. I hope that great show. Thank you, Mark. Appreciate that. Thank you for your question. Money Mike, your first time with us. Thank you for your questions. All the rest of you guys, if you have questions about anything that I've covered, especially the options, let me know. I have space on the October show to cover it a little bit more, although it's pretty in-depth now. I'd say first watch it a little bit more, and just know that we are putting every single effort, even at our place in life, right? I still plan to do this for quite some time. And we are bringing you technology now that large firms are offering their clients, not too many small or concierge firms like we like to call ourselves. Thanks for being here. Thanks for watching the show. Thanks for being a client. We will see you next month. God bless you all.